Yeah.
Okay, so we'll take up the first one now, that is self-interest threat. Okay, now you'll understand the English very easily, okay, because you have understood the concept. Now the learning will become very easy. Where the auditor has financial or other interest that will inappropriately influence their judgment or behavior. Got the point? So you have some kind of interest which is inappropriately, that means you're not doing your work in the right direction. It is inappropriately influencing your judgment or behavior. Okay, then first example or the first situation where there is going to be a self-interest threat is because of fee dependency. Now, fee dependency, I'll give you one example here. There is a particular client A Limited, okay, and this is our firm of ACCAs. Okay, we are 4 partners, partner A, B, C, D. Okay, now our firm, okay, one of the client for us is A Limited. Our firm's total revenue is 10 crores for the year, out of which 2 crore actually comes from whom? A Limited only. So the major portion of our income is coming from whom? A Limited. Now, obviously, don't you think if suppose I lose A Limited, I am going to lose the major share. Got it? Because of which you will be having some kind of interest in this particular client. Your financial interest is hidden in the client's financial statement, because you'll say, if I give a modified opinion, if I identify mistakes and I give modified opinion, next year they might not appoint you. And if they don't appoint you the next year, you are going to have a loss of 20% straight on your revenue. Now, don't you think you have this kind of financial interest in this particular client? Correct?
Yes. Yes.
Because
Yes.
of which
Yes.
you will not be able to give your opinion in a perfect independent manner. Rather, you will become biased towards this client because you have the fear of losing the client. Because there's a possibility of fee dependency. You're dependent upon the client's fees. The major portion of your income as a firm is coming from where? This particular firm, from the company. Got the point?
Correct.
Okay.
Yeah.
So what they say, threats can be created if fees represent a large portion of one partner or one office of the firm. Got it? So when I give the example of 2 crore out of 10 crore, 20% is a large portion, which is purely dependent upon A Limited's audit. So in that case, definitely we don't want to lose A Limited, because of which we will try to be a little compromising on our objectivity. Okay, then over dependence could lead the auditor to ignore the adjustments. So we don't try to correct the misstatements required in the financial statements with the fear of losing that client. Is the concept clear?
Yes.
Yes. Factors relevant when evaluating the threat include operating structure of the firm, okay, whether firm is well established or new. See, if it is a new firm, okay, suppose you have started this year, obviously you're going to have some 2-3 clients, maybe big ones. So in this case, what happens, it becomes very important for you to understand that you actually maintain the clients. Okay, because you're in the beginning phase, you'll have very less number of clients. So in order to maintain these clients, you could become what? Biased towards them, because you have the fear of losing them. Got it? Then
Yes.
the significance of the client to the firm. Just now I gave the example of A Limited. A Limited was really significant to the firm of ACCA that we discussed, because 20% of the revenue was getting contributed from them. Got it?
Mm.
So you are going to see
Yeah.
the entire structure of what all things will tell you that yes, there could be a fee dependency. Okay. Now this point becomes very important for exam, because it could come in the exam as a objective question also, or they could give a case study kind of question on this. Okay. Now,
Okay. Okay.
this is a safeguard. Okay. Now, when we understood that there is a particular client from where we have a major portion of our fee coming, or we have fee dependency on that client, then in that case, what safeguard can you take to mitigate this threat? So they have given in 2 ways. Non-listed companies is separate, listed companies separate. So in case of unlisted companies, that is non-listed companies, what will you do to eliminate or mitigate the threat? If the fees from an audit client, that is, it could be company, anybody whose audit you're doing, represents a large portion of the firm's total fees, the firm should implement safeguards such as increase the client base. Logically correct?
Yes.
So
Straightforward.
see, suppose if you have only 4 clients, so obviously your total dependency was on the 4 clients. Your client 1, 2, 3, 4. Okay. These are the major contributors of your fees. So obviously you are dependent upon these 4 clients only for the fees that you're receiving for the year. So any one goes, major problem will be for you, because you will lose a major portion of your income. Because of which, what they say, don't try to concentrate a large portion on one particular client, rather increase the number of your clients. So increase what? Make 5, 6, 7, 8, make the number of clients increased. Because if any one client also you lose, You will not be dependent upon them. You'll have multiple other clients from which you can recover the fees. Is it clear?
Yes.
Right then. Having an appropriate reviewer who did not take part in the audit review of the work performed. Now, this point, take it like a thumb rule. Everywhere we study safeguard, you will be having appoint a reviewer. Okay, reviewer is somebody like, if suppose you have a firm, ABC, okay, it's an LLP suppose, and that's an ACCA firm. What happens is always they believe in appointing a person who is outside the entity. What they do is they'll be called as the reviewers. Obviously, these people have all the knowledge about accounting, auditing principles, everything. Whenever audits are conducted, these people will come and review the work, whether actually the audit has been done correctly or not. So when you have a reviewer appointed, then it is always going to be a double check whether work has been done independently or not. Okay. Usually we appoint external reviewers, but there is also a possibility that you can have internal reviewers. Internal reviewers could be like, suppose if there are 3 partners, A, B, C, the work which C does, other partners could review. But the work which B does, these 2 partners could review. Okay. So you could have internal reviewers also, or you could have external reviewers. But what would be required would be external reviewers because they'll be more independent. They'll be able to review the work even better. Got it?
Got it. Yes.
All right. Then. Now comes to listed entities. Listen to this very carefully. A firm's independence is threatened and should be reviewed when, if total fees from a listed audit client exceeds 15% of the firm's total fees for 2 consecutive years. What they are telling is, you are an ACCA firm, and if it is a listed client means listed on the stock exchange. This particular company, okay, this particular entity is contributing 15% or more of your total revenue. Suppose 100 lakhs is your revenue. Okay, I'm giving in all the Indian rupees. If 100 lakh is the revenue, 15 lakhs actually comes from where?
From this company.
From this company. And that is happening for a continuous period of 2 years.
Okay.
Then it is better you don't become the auditor here. 3rd year, you are going to avoid to be the auditor, because then we are going to have a concept that there is a threat that the majority of the fee is dependent upon this particular client. So the partners could be biased.
Okay.
Got it? But suppose you still want to continue. If you still want to do the audit, then you have to apply what? A safeguard. Correct?
Right.
If you want to apply the safeguard, then they say an engagement quality review should be performed by a person, not the member of the audit firm. Okay, not the member of the audit firm. So what they're telling is, first of all, they say A Limited is a listed company. Your firm XY LLP has been doing the audit of A Limited. Okay. And the fee that A Limited is giving you is 15% or more of your total fees that you receive from all the clients together. Okay. And this is happening for a continuous period of 2 years. So we bring in a concept that this is considered to be larger portion, because of which we say there is a threat of fee dependency. Correct? So it is better 3rd year you don't do the audit of A Limited. But then, however, if you still want to continue to do the audit of A Limited, then you have to apply the safeguard. Okay? What would be the safeguard here? An engagement quality review should be performed by a person, not a member of the audit firm, expressing the opinion, or by a professional regulatory body. This can be performed either as a pre-issuance review before the 2nd year audit opinion is issued, or post-issuance review on the 2nd year audit before the 3rd year audit opinion is issued. So what they're telling, if you are continuing to do the audit, then what you do is, when your 2nd year audit report is ready, okay, before you actually release the opinion, you appoint an engagement quality reviewer. Reviewer is going to be somebody external outside the firm. He has to come and check whether the audit that you have performed is actually done correctly or not, whether you have independently performed the audit. Either you do before the audit report is given to the management, or you can also do after the audit report is already submitted. Okay, that means opinion already released. That is called post issuance. But it has to be done compulsory before you give the audit report of 3rd year. That means third year report will be available, or third year audit you can actually do only when this review is completed by you. Review will happen from whom? External party.
External party.
Yes.
Understood.
But
Yes.
two options for the review. One is that you either do it pre-issuance, that is before the second year report is given, and you do it. Or you have another option that you can do after the second year report is given. But in any way, you cannot give the third year audit report without doing the review. So your third year's report will come only and only after the review has been conducted, and the engagement quality control reviewer has been told very clearly, has told you very clearly that yes, independence is there. That means they have done the work as required by the standards, and independently they have done it. They have not been biased absolutely. Only then the third year report can be released. Otherwise, you are allowed to do only for 2 years consecutively. Is the concept clear?
Understood. Understood. Yes. Clear.
Okay.
Very clear.
So that is a
Yeah.
safeguard. Okay.
Okay.
Just please
Okay.
remember for the examination. Okay. Very, very important.
Okay.
Okay. And obviously, how will the auditor understand about all of these things, whether it's 15% and all? Here, what do you do? The firm should disclose the issue to the TCWG, because the remaining all information will come from whom? The TCWG only. That is the
Yes.
senior management. Got it? Okay.
Okay. Okay. Okay.
Okay. Further, they say, if the fees significantly exceed 15%, okay. Now, this is very important. What options are there? 2 years, you do either pre-issue, okay, or if you do post-issue, it should be before the third year. Correct? But there is one situation where compulsory you have to do pre-issue only. That is before the pre-issuance. If fees significantly exceed 15%, so suppose it is 30%, 35%, 25%. So this is quite a major portion. So if it is crossing 15% significantly, a pre-issuance review should be performed if a post-issuance review would not reduce the threat to an acceptable level. So when you're significantly exceeding 15%, then we will highly recommend that you actually go for what? Pre-issuance. Okay, that means pre-issuance review. That means before the opinion is submitted, before that only you conduct the review. Is the concept clear?
Yes.
Okay, this would be like an MCQ question. Okay.
Okay. Okay.
Then moving to the next one. Now, gifts and hospitality. What is hospitality?
Hospitality means being warm and welcoming.
Right. So we are still under self-interest only. We are doing all the possible scope for self-interest threat. First, we studied about, just now we studied about fee dependency. That is also self-interest. The second scope of self-interest will be gift and hospitality. Now, the client is trying to gift you something.
Oh, the points under self-interest threats are also exhaustive set of points.
No, not exhaustive, illustrative.
But they're not exhaustive? Illustrative.
Yeah, they're purely examples.
Okay.
Just for you to get a clear concept of what is self-interest. Which are the possible ways through which self-interest could be.
Okay. Still, they are explaining each and every situation. For example, gifts and hospitality and all that. Okay.
Yeah. Now, first is they're telling gift and hospitality. If they suppose the client is gifting you something or trying to be actually too good to you, okay? Don't you think somewhere or the other, these gifts that you receive, okay, could also influence you?
Yeah, it will definitely.
Because somewhere or the other, this gifting, this hospitality and all that, the way they behave with you and all that, is somewhere they're trying to, behave very, 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 trying to show you something and trying to develop an interest of yours in their business, because of which automatically what will happen, the way in which you approach only will change.
Yes.
He's given me gift. Okay, how can I give a wrong opinion for him? Okay, he's gifted me so many things. So somewhere or the other, a kind of, the thinking of the auditor will go on changing. So don't you think it is going to affect or influence your decision making?
Definitely. Yes.
It will. But suppose if it is a very small amount, okay, or very inconsequential, that means the amount, like for example, a diary. Okay, like usually what happens is when you go to a client's location, the client will be having, diaries printed for a particular year. So basically, we auditors actually take those diaries because we use it and all. So we ask them, give us also one diary and all. So in that case, the gift is what very small. It is immaterial. It is not going to have any impact on changing your opinion and all. So those kinds of gift, if you're accepting from the client, no problem, you can accept, no problem. But then suppose if it is such a gift which you're taking, which is significantly going to impact your, opinions. It is such that you're coming as if it's a favor coming from the client to you. Then in that case, it is going to affect your objectivity and you will end up giving opinion in their favor without looking at the adjustments or without looking at the real picture. So that kind of gifts we say do not accept. So the safeguard here is that Do not try to accept those gifts, or do not accept those gifts or hospitalities which are actually going to impact your decisions. If there are gifts, or if there are any kind of other treatment that they're giving you, which you don't think it is going to affect you in your decision making, then those type you can take. Like these calendars, diaries and all which they're giving you, no problem. They're very small. Their even amount is involved is very small. So those type of things you do not go. But suppose they're trying to gift you a phone, okay, which, with a heavy value and all that. Now, these are all trying to show you or please you in such a way that you'll be understanding that, array, isne mobile diya hai, so we have to actually, work in, not be in a position to actually freely give a negative opinion.
Yes.
But it will impact your thinking. Psychologically, it will definitely impact.
Yeah. Yes. And understand very clearly. Yes.
Acceptance of goods, services, or hospitality from an audit client can create self-interest, intimidation, and familiarity threat, as the auditor may feel indebted to the client. Is the English understood? You start feeling that you're indebted. Now, what is intimidation and familiarity? I just give you an introduction to it, but when we come to it in detail, I'll teach you again. Okay?
Yeah. Understood.
So, what is the safeguard? All the boxes are the safeguard. Okay, or everything printed in the boxes will be your safeguards. So, the safeguard is gifts and hospitality may not be accepted unless the value is trivial and inconsequential. Trivial means very small. It is immaterial. Doesn't matter. If that much is the value, take it, no problem. And it is inconsequential. Doesn't have any influence over you. Gifts and hospitalities which are trivial and inconsequential, but which are intended to improperly influence the behavior of the recipient, should not be accepted. So don't look at the size of the gift. Don't look at the nature of the gift. Don't look at the size of the service, nature of the service. Look at the intention. Is the intention to influence you? If the intention is to influence you, then please do not take any kind of service, any kind of gift from the client. Otherwise, you will have to compromise on your objectivity. So that is a safeguard that you put up. Clear?
Okay.
All right. Then, this part I already explained you. I don't think you need a more explanation for this, because I told you when you yourself own shares in the client.
Yeah.
Obviously, you're going to give a good audit report, because that audit report is going to the public. And obviously, the faith in the public will remain. And in your own investments, you don't want the market to come down and for you to lose the money. So when you have your own interest in the client, why will you give an opinion which is going to affect your money or your investment? Got it? So what do you think will be the safeguard given there?
Obviously, the firm must not own any interest in the company.
Correct. That's a safeguard. Very simple. Okay.
Yeah. If it owns, it should not do the audit for that.
Yes. Got it? Yes. The auditor will want to maximize return from the investment and overlook audit adjustment, which could affect the value of the investment. And understand, in India, we still have that kind of approach, or maybe any person for that matter, when it comes to his money, okay, he will never want it to go down.
Yeah.
Correct.
Yeah.
Anything affecting the value of his investment, he will be obviously biased towards it.
Yep.
Got it? Then, when evaluating the threat, the factor which should be considered include who holds the financial interest and whether financial interest is direct or indirect. See what happens, it becomes very important whenever you look into financial interest. Two things you'll consider. First, who is holding it? And second, is it going to impact you directly or indirectly? For example, you obviously, if you are holding, it is going to directly impact. But there is a possibility that even your relative could hold. Correct? So there could be a possibility your brother is also holding shares in the company. Correct? But that will indirectly impact you. Understandable?
Yes.
So whether it is directly, whether it is indirectly, whether it is you, whether it is your relative, whether it is your partner in the firm, whether employee of your firm, whoever it is, they should not be holding any kind of financial interest or any kind of interest or shares in a particular client. If they are holding, it is directly or indirectly going to impact you, which is not considered to be appropriate. It will compromise your objectivity. Is it understood?
Yes.
Okay. So look at the safeguard. In safeguard, what points I have told is all covered here. A direct or material indirect financial interest in the audit client must not be held by the firm or network of the firms. So any of your branch, your main office, any employee of any of the branch, any of the network, the same common chain that you have, whatever it is, no place you should have any kind of holding. Because network, if you talk about KPMG, now KPMG by itself is a network because it has placed everywhere. So throughout the entire network of KPMG, there should not be a possibility of them holding any shares which will directly or indirectly impact what? The decision making. Got it?
Right. Yeah.
Then audit team member or the immediate family of the team member. So not only the partners, we also say team members should not have any kind of holdings. Okay. Then a partner working in the office connected with the audit engagement partner. So any partner of the auditor also should not be holding any kind of interest. Then any partner providing non-audit service. Now, when you look at a firm of ACCA, okay, you will never see that they're only into audit. They will also be providing tax consultancy services, some management consultancy, some bookkeeping services. There are going to be return filing. There are going to do so many activities together, which we call it to be non-audit service. Correct? So they're saying, do not even try to provide what? Any partner which is providing non-audit service. So there are two partners, A and B. A is doing the audit. So you should not only look at A's interest, you also have to see what? B's interest also. So even though B is not into audit, B is providing other services, even then you will see whether B is holding any kind of interest in A Limited. And if B is also holding, then we say this firm should not take up the audit of A Limited. Is the point clear?
Yeah.
Okay, then moving further, suppose they say, here we have also included the point of relatives. Correct? Now tell me, you have got the audit of A Limited. There could be a possibility that your brother is already holding shares of A Limited. Is it possible?
Yes, yes.
So there
Actually, I was about to ask this.
Yes. So your brother is already holding. So relative is already holding a share in A Limited. Now you became the auditor. Correct?
Yeah.
It is very important to understand that you approach your relative and tell him as soon as practicable, please dispose of the shares.
Okay.
Sell the shares. If it is not happening and if he denies, then you are not eligible to continue in this firm as the auditor.
Okay. Okay.
Got the point?
Yes.
Okay.
So I was about to ask, like, if as a team in an audit firm, say in a Big Four company or any companies, so they'll be asking some declarations or something like that before going to a listed client audit.
Yes.
Oh, okay.
So that thing is what, just now we understood. If you look on top, what point you told me now is the same thing that we discussed here. In the beginning, I told you, the firm should make policies and procedures to identify threats.
Okay.
That is the procedure.
Okay. Okay.
Got it? Where forms and all are filled up, right? They're all called as the procedures to identify the threats.
Okay.
Got it? Yes.
Yes.
All right. Then, so they say the immediate family members may hold a financial interest. Like I told you, brother may hold a financial interest, such as pension or share option. Like there could be prior employees, because of the retirement benefits, they've got pensions and share option plans and all that. But they must dispose it off as soon as practicable when the family member has the right to do so. Example, when there is a right to exercise the option. That means they're saying, no problem, you take it, you hold it. But see that you actually have to dispose, that is, sell it off once it is possible for you to sell it. That means you cannot continuously hold it. When you take India's Indian law in precise or in particular, when you talk about Companies Act 2013, okay, very particular in Companies Act also this disqualification is given. That means if an auditor or his relative, if they hold securities in a company, then they'll be disqualified to be the auditor of that particular company. But then what they have told is relative can hold certain amount of shares. Okay. So there they have given a limit up to which they can hold. Even then auditor can become the, this person can become the auditor. But then what they say, suppose over and above this limit is 1 lakh. Okay. As per Indian law, up to face value of 1 lakh, you can hold the shares. Okay. It is allowed. But suppose over and above 1 lakh, if you're holding, suppose you're holding 1.2, then this 20,000 you have to compulsory dispose of. Correct? And here what they're telling, this timeline is only 60 days available for you. That means from the date of appointment of A as an auditor in this company, within 60 days, this relative has to sell off the additional shares.
Okay.
And if suppose the relative does not sell off these shares, then this auditor will automatically have to vacate the office.
Okay.
Understanding? And then you remember we did a term called casual vacancy.
Yes. Yes.
This will amount to casual vacancy.
Okay.
Before the expiry of the tenure, if he's removed, we call him to be what? Casual vacancy. So this will vacate the office and become what? A casual vacancy.
Oh.
Okay. Understood the point? So that was particularly about Indian law. Okay. Okay, so everywhere they have told it is as every law tells the practicable timeline within which you have to dispose. Like in India, we have 60 days. Like that, you'll be having depending upon the country to country. Okay.
Okay.
Then financial interest received, it could be indirectly also. That means by inheritance. So there could be a possibility that there is a shareholder of the company who has written you as a nominee. Correct. So on the death of the shareholder, by inheritance, could you become the holder of the shares? That is basically inheritance. Okay.
Okay.
So even in that case, you are required to dispose of the shares. You cannot hold it. Or maybe you are a legal representative of the shareholder.
Okay.
In all those cases, we call it to be inheritance or gifted. Okay.
Whatever means I have interest, financial interest in the company, I'll have to dispose it off.
That is a simple idea. And let the financial interest come to you anyhow. Whether you bought it, your relative bought it, you got it like a gift, you got it like inheritance, by the will of somebody, all of that doesn't matter. Ultimately, the only criteria for us to check is do not hold financial interest. Okay. If a close family member of an audit team member holds a direct or material indirect financial interest in the audit client, the person must be removed from the team unless the financial interest is disposed and an appropriate review of the work must be performed. See, I told you that this word will come everywhere. Whenever you talk about safeguard, a review must be conducted compulsorily. Okay? And here what they're telling is, suppose there is one engagement partner B, Mr. B, and he goes with 5 people together to do the audit. So this entire thing is called as the audit team. Got it? Now, suppose there is a threat of this out of the 5, there is one person, okay, they have identified that there is a financial interest. So what you will do, this person you remove from the team unless and until this financial interest is actually getting disposed of. So suppose you're going to audit of A Limited. So you have decided all of us will go together to do the audit of A Limited. So your 5 plus 1, 6 people as a team will go to do the audit of A Limited. But then as you did the identification of the threats, you understood one of your employee is holding a financial interest. So what would be there? Now you are going to give him some time because his relative has to sell off the shares. So until he sells off the shares, the relative sells off the share, what you will do? Look, you don't be a part of our team. Remaining of us will go and do the audit. You will join us or you will be a part of the team again once the financial interest is getting disposed of by you. Now, this is very common, okay? In India, so we see this very common, and in the practical environment, very, very common. Dinners together. The client, whenever you go to do the audit, will take you to all the expensive hotels, give you proper meals, very fancy hotels, very fancy facilities will be given to you with only intention that because of all these gifts and all, you feel indebted to him and you feel, Arey, he's doing so much for us. So it is, how can we report wrongly? How can we find his mistakes? Let us not do it. He's doing so much for us. So in order to bring this kind of, influence over you, they try to treat you a little extraordinarily. Okay, so one of the best example is to take you to the most expensive hotels and give you expensive meals. Okay. And not only you, but the entire team. So what they do, a client offers to take the audit team out for an expensive meal. So they take you in Taj, okay, all these kind of premium hotels you go. This creates a self-interest threat. Matters to consider before accepting or rejecting the offer includes whether the meal is before or after the auditor's report has been signed. Got it? Very nicely they have told. See, if they're treating you after opinion is given, it is not a threat.
Right.
Because opinion already given. So only as a part of hospitality, only because you're the auditors, for your dignity, they're taking you. Or for the respect that they have. But if it is before signing the audit report, and they take you to a meal like this, then understand there is something going on in their mind where they want you somewhere or the other to change some things in your report. Got it? So if they say, if before the offer of the meal could be intended to influence the outcome of the audit, that is something is there in the report which they want to change, okay, because of which they are taking you where? To a meal which is very, very expensive, thinking that this would actually change your decision. Moving on to the next one. So we did how many points now for self-interest? First was regarding fee dependency.
Fee dependency. Then we saw something on gifts and
gifts. Then we saw
hospitality. Gifts and hospitality, and interest. The other share investment.
Okay, owning shares.
Yeah, owning shares.
Or any kind of financial interest.
Financial interest.
Got it? Then it comes to loans and guarantees. Okay. Now, understand very clearly, when you want to be the auditor of a particular client, see that there is no any transaction like this with that of the client. Do not exchange loan. Don't give, don't take the loan. Guarantees, don't stand as a guarantor, don't take a guarantee from the client. This is definitely going to impact the objectivity of yours. When you have taken a loan from someone, okay, don't you think you'll be having that kind of fear in you that if I report badly, or if I actually give an unfavorable report, then in that case, that person might ask for the loan repayment immediately. Correct? He might say, give us back all the money. We are not extending the contract anymore. We want our money back. Don't you think?
Yeah.
Correct? But suppose it is a bank and you as an ACCA obviously can do the bank audit. Now it is a bank where you have taken some 2-3 years back some housing loan. Now tell me, this housing loan, does it have any kind of connection with the audit that you're going to do? This you took it when first of all, this was not your client.
Yes. This has actually no connection.
Yes. And this you took it on commercial terms.
Correct.
Did they give you any kind of preferential rate? Did they try to give you some concessional discounts? Did they give you some other repayment schedule as compared to others? Nothing was done. They gave you as you are an ordinary customer to them. So when this is happening, which is going to be on a regular commercial term in the normal business process, that is not called to be something threat. Understanding? So here we say that yes, there is no threat. So this is acceptable. Apart from this, if there is any kind of other thing, any kind of other loan or guarantee which is getting exchanged, then in that case, this is going to impact your objectivity, where you will have some kind of influence, wherein you have some kind of personal interest involved, where you are actually going to do what? You are going to try to safeguard, or you not give a favorable kind of opinion, unfavorable opinion on the financial statement. You will give in the direction of the client only. Got the point correct?
Yeah.
If suppose you have given the loan to them and then you give an unfavorable opinion, tomorrow there could be a possibility they might not repay you back on time. They'll simply trouble you for the repayment. Got it? Or if they have given you, they might instantly cancel the loan and take the money back. Got it? But suppose that I'll give you one example of a bank where a threat could be present. Okay. Now, bank ordinary course is what to give the loans. So bank usually we consider it to be okay, fine. If you're doing the bank audit and if you have a loan there, then it has happened on the normal terms and conditions. Then we don't consider that to be a threat. But now suppose you have been with 5 team members to do the audit. Okay. As you were doing the audit, okay, the bank manager approached one of the team member and said, look, if you are in the need of loan, we will give you. And that too at a very good rate. Now tell me, here this offer of loan by the bank. Okay. Don't you think now this is a threat?
This is, definitely a threat because
this happened basically when you were doing the audit.
Correct.
They understood you were the team of the audit, the member of the team. And because of this relationship only, they gave you the offer.
Yes.
And they're also giving you some kind of preferential rate or maybe a reduction in the rate and all that. Now, all this definitely is going to impact the objectivity, because you'll feel, I don't know, they are giving me loan. So if I don't give a proper opinion or if I don't give a favorable report, this loan proposal will get cancelled. They might not give
I might not get it. Yes. Correct.
And these people might not give, and I'm in actually urgent need of this money. And they might cancel this particular proposal. So don't you think this will impact my interest, because of which I will actually give a favorable opinion? Yes. So that is said, loans and guarantees also not acceptable. So what will be the safeguard? Do not accept any loans, any guarantees. Do not give, do not take from the client. Okay. Got it? So now, the significance of the threat depends upon whether loan or guarantee is with the bank or other financial institution, and whether the amount is material. If you take a loan of 10,000, 50,000, we don't consider it to be material. This is not going to impact. But obviously, if you have a big amount taken, then obviously that is going to be important. So we also look into the materiality of the loan amount. Okay. And if it is bank and financial institution, you will also check whether it is on commercial terms. Really, as per the customer of the banker, you have got it, not as a part of audit team. Got it? Then, loans and guarantees to the audit client are not permitted unless they are immaterial to the firm or individual making the loan or guarantee and the client. So if the amounts are immaterial, then you can take, no problem, absolutely. Take and give, we have no problem. But if they're definitely material, then we are not going to allow you to be the auditor of that particular client, because your influence will be, there'll be something which is going to influence you. Got it? Then, this is important. Loans and guarantees between the audit client, which is a bank, or similar financial institution and the firm, the audit team member and their immediate family that are not made under normal lending procedure, terms and conditions are not permitted. That means even if it is bank, even if it is financial institution, whether you take a loan, your family members are taking a loan, or any member of the audit team is taking a loan, and these are happening on terms and conditions which are not normal. Normal means for a routine customer, what they're giving it is not in that line. Then in that case, you are not permitted to exchange such thing. That means you cannot become the auditor. Got it?
Understood.
Yes. If an immaterial loan from a bank or similar financial institution is obtained under normal lending procedures, see, first of all, immaterial, and it is normal, then in that case, obviously you cannot accept as it is. An appropriate reviewer who is not the part of the audit team member should perform the review of the audit work performed. Every safeguard will give you this point. You have to appoint a reviewer who is going to not be a part of the audit team. Okay, should not be a part of the team. It should be some external person altogether. If it is a team of 6 members, it should be the 7th member. This 7th member sometimes could be internal from the firm only. Usually you will have it external. External we recommend because it is going to be more independent. Got it? And this 7th member is considered to be a quality control reviewer. Got it?
Yeah.
Okay. So every time when you put a safeguard, right, you always ensure whether safeguard is done or not by engaging a reviewer, quality reviewer. And only if he gives the understanding that yes, it is done correctly, that means yes, things have been correct. Got it? Then a loan or guarantee from an audit client, which is not a bank and financial institution, is absolutely not permitted unless it is immaterial. So we are telling banks and financial institutions you can take up, but they should be in the normal course. They should be immaterial. Okay. But from others, other than bank and financial institution, if you have an audit client, then you cannot take only loan from them unless it is immaterial. So obviously you have 5,000, 20,000, 25,000, 50,000 and all, depending upon the size of your firm. If that considers to be an immaterial amount, okay, a firm like 110 crore being the turnover and all that, for them, 50,000 will mean nothing. So that will be considered to be what? Immaterial. Okay. So depending upon the size and the nature, we understand whether it is material or not. If it is immaterial, we don't consider. But if it is material loan and guarantee, that is going to be very important for us to understand whether threat is present or not. Clear?
Yes.
Then overdue fees, very, very interesting. Okay. What is overdue fees? Overdue.
Okay, overdue fees. Overdue fees means like the amount is payable by the client to the auditors, but they have not paid yet.
Not paying. Okay, so maybe there is year 1 where you have done the audit. Yeah. Year 2 you have done the audit. Now you are in the year 3. Year 1 and 2 fees 10 lakhs outstanding. They have not paid you. 3rd year you are the auditor. Okay, you have to receive money from them. Okay,
right.
Don't you think this year automatically you will be somewhere or the other inclined, or you'll feel no, I'll give a favorable opinion, because if I give a favorable opinion only, then I'll be able to recover this money quickly.
Yes, possible. Yeah, correct. Yeah.
Don't you think it's a kind of threat being an overdue?
Definitely.
You will definitely, because see, also one position could be, suppose this particular client is facing a financial crunch. They actually have no money to give you. Correct? So now they must have planned that they want to take a bank loan. Okay? With which they'll be able to settle my fees.
Okay. For that, my report is very much
necessary. Banker will never give you loan without my report.
Yeah.
But even the 3rd year, if I give a modified opinion, if this modified opinion is taken by this company to the bank, will the banker give loan?
No.
No. And if the banker does not give loan, is there a possibility for you to recover the money now?
No.
So you want your money to come back, right?
Yeah.
And for this money to come back, this company requires a loan. And this loan is not possible without my report. So for the purpose that they get loan, I will actually give a true and fair view only, because they should get loan in order to settle my fees.
Yes.
Got it?
Understood.
Yes. So this is the overdue fees, which is a big threat which is present. And in our field, fees are a very big thing to be overdue. Okay. Very rarely we receive money on time from the clients. Okay.
Right. Yeah, correct.
Overdue fees may be seen to be a loan to the client.
most of these points actually, I can actually feel those points because practically I've seen
And these are all
most.
practical oriented.
Yes,
The
yes,
earlier chapter
yes.
which we did, no, corporate governance. Okay, that topic I always tell it is all theoretical. It's all on the paper. We only see it and all that. Very rarely we
Mhm,
actually understand all that thing. But when we talk
mhm,
about this topic, right, these all things
mhm.
actually happen.
Yeah, and I can understand from both the ends as well. When I was working as internal audit, I
Hmm.
could feel the side of the auditors. And right now, I'm on the client side.
Hmm.
I actually this overdue fees, it is, yeah, practically happening in my
Impactful.
company.
It
Yeah,
is impactful, yes.
yeah, all these points, yes, I can very much relate to them
Yes. Hmm.
practically.
Yeah, so that's the learning. That's the reason, when you see all this and you really have an exposure also, things become very
Mhm.
understandable, very easily understandable.
Yes,
Okay, all
yes.
right. Now, overdue fees may be seen as a loan. Obvious becomes like a loan only, right?
Mm, mm,
This
mm.
money is recoverable from the client, and anything that you recover from somebody is like a loan to them.
Right.
And just now we discussed in the previous session loans and guarantees.
Mm,
Right. So, where you feel that there is a kind of loan present, do not do the audit only for the third year
correct.
because you will obviously be biased.
Mm,
Got it? The
mm,
firm may also treat the client favorable to ensure the fees are paid, which I discussed just now with you. Correct?
mm, mm, mm.
Factors which should be considered while evaluating the threat include how long the debt has been outstanding and the value of the debt. If the amount is only 20,000 outstanding, obviously it will be immaterial. Okay. But if the amount is really big, then it is definitely going to act as a threat. Small amount like 2,000, 5,000 and all, those amounts cannot be considered to be threats. So you will look at the materiality also and how long they have been due. If they're due for only 3-4 months and all that, or 1 year, then that's not considered to be very serious because normal it is. But if it's been really due for long time, 2 years or more, then definitely we call it to be what? A long-term one, which means they're not paying, it is becoming like a loan from them. So in that case, obviously, in order to recover the money, we are going to be biased. Okay? Then
Okay.
the self-interest threat may be created if a significant amount of fees is not paid before auditor's report for the following year is issued. Got it? Okay. Just now the example that we discussed was that only following year. Year 3 was the following year for us. Correct? Then to manage the threat, the firm should obtain partial or full payment of the fees. This is only on the paper. It is not in our control only actually. Okay. The
Okay.
safeguard is that try to recover the fees as and when the work is done. Okay. Then,
That, yeah, yeah, understand.
and obviously the next safeguard in common for everything is what? Appoint
Uh,
appropriate reviewer.
appropriate review. Yeah, yes, yes, yeah.
This is a common
Appropriate
point for everything. This is a common thing
everything.
you're going to write in every answer of safeguard. Have an appropriate
Okay,
reviewer
okay.
who did not take
Mm.
part in the audit to review the work. Got it? Okay. When
Who
the fee,
practically in reality, I have not came across this concept. So who does it? Another firm or
see,
how does it
basically it's
work?
the concept which comes for external audit.
Yeah, external audit. Okay.
Correct? So usually what happens is, just to give a simple understanding, suppose there are three partners ABC.
Hmm.
Every client will be handled by respective partners. Correct?
Yes.
So
Yes.
there is suppose one client called Z Limited. The entire audit will
Yes.
be done by this person.
Yes.
Usually what
Okay.
happens is the other partners will review the work done by him
Yeah, you said internally. You gave this
internally.
example
Otherwise,
earlier.
there is also a possibility that you actually outsource the review work. You appoint
Hmm.
external agencies
Who
or
will be these
external firm
agencies
altogether.
again? Firms only.
Yes,
Again, CA
yes,
firms only.
yes.
Okay. Okay.
These will be doing the review of the work that you have done,
Okay. So
just to
okay. The
ensure that
C.
your work is done independently or not.
Hmm.
Got it? Usually, it is the partners who do it. The partner who was not the participating one in that particular assignment, that partner will be doing the review.
Review. Okay.
Got it? Yes.
Okay.
It's like a double check to ensure the
Hmm.
quality of service that you're maintaining.
Okay.
Okay? Yes. Now, this point is important. When the fees remain overdue for a significant amount of time, the firm should consider whether the overdue fees constitute a loan and whether it is appropriate to seek reappointment or continue with the engagement. So just now when we did the example of first year, second year, and I told 10 lakh is the outstanding amount, looking at the value, I should decide whether it is significant or not. And if I believe it is significant, third year, I will think twice whether I should take up the this engagement? Should I seek for reappointment or should I continue or not?
Okay.
Got it? So this becomes one of the major discussions. Looking at the amount, materiality, you have to decide whether you should continue or not. In fact, the meaning is, should you continue or should you withdraw? Got it? Because that 10 lakh will definitely impact your decisions. And you will not be independent enough to do your work. Okay? All right. The last thing that we take up today will be regarding the business relationship. Okay, now a very simple question I ask you. Tell me, if suppose you want to become the auditor of maybe Taj, is it that you're never going to buy from Taj anything? Or you're never going to visit to the hotel?
Not like that.
Okay, if suppose it is telecommunication. Okay, only because you are, you're a auditor of Airtel, is it that they will be debarring you or maybe banning for you to take the connectivity of Airtel here?
No, not like that.
So it is what business relationship. Business relationship is basically trading, etc. that we do. So buy and sell. Okay, that is called business relationship. So they say that this particular auditor, the ACCA, should actually not have any kind of business relationship with the client, because if you have a business relationship with the client, obviously you'll be interested in the operations of the client. Correct? Okay. And you want the operations to be looking good because your interest is also involved. Correct? So because of which they tell, do not have any kind of business relationship. Okay, do not give any kind of, don't buy anything in bulk from them. Don't have a regular transaction with them. Because if that is the case, then definitely there is going to be a possibility that you might lose. Like, for example, if suppose you are a person who is who would require laptops, okay, for your purpose of your office. So this laptops, you have decided to buy in bulk around 20 laptops you require from a particular client. Now, when you look at this client, he's going to give you 20 laptops. Okay. He's going to give you a bulk discount on this.
Yeah, definitely.
He'll give bulk discount, correct?
Yes.
But now suppose if you are only the auditor of this particular client, okay, and suppose you end up giving unfavorable opinion, don't you think you have the fear of losing this bulk discount?
Yes.
Correct. So somewhere or the other, your interest is involved.
Yeah.
Because of which we say that please do not try to have such kind of
when there is business relationship there. Yeah.
Do not try to impact or do not try to have such kind of decision. But then understand, if it is happening at regular pricing, normal, it is not because you are the auditor, they're giving you less or they're charging you less and all that. Whatever you're giving to the outsider, same amounts are charged from the auditors also. Then in that case, what we say, that no, this kind of business relationship, let it be. We have no problem because that is not a threat. As per Companies Act and all, we call it to be arm's length price.
Transfer pricing policy.
Yes. So when you're doing things at arm's length price, it is not going to be any issue because that is normal course of practice. But if you're trying to give any concessional rate where there is going to be some kind of benefit you're deriving and all, then those kind of relationships, please do not maintain. That will influence your decisions. Got it? Okay. If the audit firms or members enter into business relationship with the client, example like joint ventures, combining products, or service of each party, distribution or marketing arrangements, this leads to self-interest because the auditor would have an interest in the successful operation of the client. Because as the client will grow, you will also grow. Or if the client is supposed to pay you money, okay, and if their business fails, then in that case, you will not be able to get your money back. Correct? If you're providing some service to the client requires to pay you. And suppose if you give a modified opinion, there could be a possibility the client's business could collapse. So in that way, you will not even be able to get your fees properly. So you will definitely have an interest because you'll be interested in the operation of the client because your recovery of money also will be dependent on that. Correct? Then the firm, network firm or the audit team member should not have a close business relationship with an audit client unless any financial interest is immaterial. So once in a while you do, like you're taking the Airtel connectivity and all that, once in a while, which is immaterial, that is fine. We have no problem. And the business relationship is insignificant to the client, the firm and the audit team member. So it is such that like visiting the hotels, okay, these all are not going to have any impact on your relationship. So if a team member goes to the hotel, if they are taking the airline services, if you want to take an air ticket and because you want to become the client or the auditor of the particular airlines, then that doesn't mean you're never going to travel by that airline. So that is something insignificant to the client, the firm or any audit member, then it's fine, no problem. Okay. And it is not going to happen regularly, right? It's going to be once in a while that you're going to do. And these things will not affect have any kind of impact over your decision making. Factors to consider when evaluating the threat include whether purchase is in the normal course of business and the materiality of the purchase. If you're purchasing only one laptop, that will not have any impact. But if you're purchasing bulk and you're regularly purchasing, every time you require a laptop, you go to that vendor only, then this is going to impact your connectivity, because of which we say threat is present. Otherwise, once in a while, you're going to buy a laptop and it is going to be only one and it is at the regular pricing. That is never going to be a threat. That is fine. Okay. Then the purchase of goods and service from an assurance client does not normally give rise to threat to independence, provided the transaction is in the normal course of business and on the commercial terms. Correct? Commercial terms means what? At ALP. If you go to a particular client, if they are charging 45,000 rupees from you for a particular laptop, if I go, they're charging me the same 45,000. That means it is happening at the commercial terms.
Yeah.
If they give you 20 days credit period, they give me also 20 days credit period. That is commercial terms. So in that terms, if I'm buying, am I getting any special discount and all?
No.
No. So in that case, we don't say it is a threat. It's fine. No problem. Okay. Then. If the purchase of goods and service by an audit team member represents material amount, okay, that person should be removed from the audit team or they should reduce the magnitude of the transaction. So suppose out of 5 members, 1 member is attracting this kind of thing, then better is you remove him from the team only. So when we go to do the particular audit of that A Limited from whom we are buying things, okay, in the team of that, basically in that 5 members team, if that person is the one who has a major transaction with A Limited, see that you remove him from the team, no? So the remaining 4 can go and do the work. So obviously objectivity will not get affected. So if any member is doing that, eliminate from the team. And if suppose the engagement partners or the key audit partners only have this kind of interest, then you have to be very careful. That means the firm as a whole, if they're buying and all, then you be very careful that you actually stop this thing. Stop the transaction, or the transaction should be immaterial or insignificant. Got it?
Yeah.
All right. So today we'll stop the discussion here. Okay. The remaining part we'll take up tomorrow. I believe things are clear to you.
Yes, ma'am. Yeah.
Yeah.
Everything.
So we have done only self-interest threat. Okay. Where we spoke first about fee dependency.
Yeah. Fees dependency.
Second, we spoke about
hospitalities and gifts. And,
third, owning shares.
Ordinary share. Owning shares.
Then we spoke about
The recent one, loans and
guarantees. Then
overdue fees. And the last one is the business relationships. And all these are illustrative.
They're all illustrative. Okay. They have given you, but illustrative is so much, that we can actually say exhaustive also, because so much they have given that very rarely you'll find something beyond this.
Yeah. So
okay. Yes. So this is the entire list and it all comes under
self-interest.
And self-interest could be either financial interest or it could be any other interest also.
Any other type of.
Got it? All right. So the last discussion that we had, that was regarding business relationship. And I believe till here everything has been really clear. Okay. So we now take up the next one, which is going to be regarding the potential employment with the audit client. Okay. Now, potential employment means that you are having some kind of intention to get employed with the client, audit client. Okay. Now, let us take an example to understand this. There is a company A Limited and we are a firm of ACCAs. Maybe we are 3 partners. So we have partner X, Y, and Z. Okay. And then we have entire people working under us. Okay. Now, what happens is one of the partner will be assigned to do the audit of A Limited. So he'll be the key audit partner who is going to be doing the audit of A Limited. He will, along with him, he'll be taking along a team, and all these together will go and do the audit of A Limited. One person here or one member of the audit team, there could be a possibility, and it's very common also, that while you're doing the audit, okay, there could be a possibility that the A Limited, that is the client of us, could actually get impressed by the way in which you're working, or they like the work that you're doing. So they could sometimes also give you an offer for employment. Got it? So what they would do is A Limited would tell this particular member, they would indirectly ask how much are you paid or how much is the firm paying you. Okay, and they would try to just kind of offer something which is high payment. So if you're telling like you have been offered some 12 lakhs there, they'll say, okay, we'll give you a 30%, 40% hike and we'll employ you at 16 lakhs, 17 lakhs. They try to give you an offer. Okay. So obviously this member of the audit team obviously will get excited about the new package. And he would think that, yes, if I do the work really well in this client, this client would be happy with me and he would give me employment in his organization. Correct? So now tell me, when you have this kind of offer coming from the client, don't you think the way in which you're going to work is something that you're going to try to impress the client, try to make the client happy? So you will not be trying to find out any kind of misstatements, any kind of mistakes that are there in the financial statement only because you want to make the client happy because they have offered you an employment in the future. Correct? So because of which we say that if there is some kind of potential employment, okay, which you're seeking from the client, then it is better that this member of the audit team, okay, you try to make certain policies. Policies could be such that this firm, okay, the ACCA firm could actually enter into a contract with every member that whenever we send you to a particular client, then it is compulsory that for a minimum period of 2 years or maybe 1 year, you cannot take employment in this particular client. So you try to make certain policies, certain procedures with that of the person that you're sending to the audit work, that whosoever audit you're sent to, you have an obligation or you have a contractual obligation on you that you will not take employment with the client. So this is the kind of safeguard that we are trying to put, okay, with respect to avoid this kind of threat. All right. So when we say potential employment, it will definitely bring a kind of self-interest threat because you will be having some kind of interest in the client's location. You will get an offer from them for which you'll be very excited and because of which you feel you want to make the client very happy. Got it? So because of this, you'll not be able to work in an unbiased manner. Your objectivity will get compromised, because of which we call this to be one of the major threats to hamper the objectivity. Okay. Safeguard would be the firm which is going to send you, they should have who is going to send you should have a proper procedure in place, proper policies designed, where they very clearly make it understandable to the members that, look, whosoever goes to the audit, you will not be allowed to take the employment for 6 months, 1 year, 2 years, something or the other you have to do and keep as a contractual agreement with them that you'll not be allowed to take the employment. If that is the case, then you'll be actually having no threat or your threat will be eliminated. Okay. So what they say, if a member of the engagement team, okay, has a reason to believe that they may become an employee of the client, they will not wish to do anything to affect their potential future employment. So obviously the one who's getting 30% hike with the client, he will surely get excited and he would want that employment. So because of which he'll develop a self-interest. So we believe that do not send a person like that in the engagement team who seeks to have a potential employment there. Correct? Then the firm must establish policies and procedures which require individuals to notify the firm of the possibility of the employment with the client. So, for example, if I say that, if I put a policy that any person who's going in the audit team, the entire engagement team, any member who's interested to take employment in that particular company should inform to the ACCA firm beforehand that they're looking for job opportunities there. Or you put another obligation that even if you want to, you cannot for 2 years minimum. Something or the other, the firm should set up policies and procedures which have to try to eliminate this threat. Okay. When such a situation occurs, the following safeguard should be implemented. Remove the individual from the assurance engagement. That is quite obvious. Correct. And then everywhere we have a common point, have an appropriate reviewer. Review any significant judgment made by that individual. So see that, suppose already this person was, like for example, 5 people went to do the audit. One of them is the person who is seeking the employment here. So you see during the course of audit, what all judgments did he make? And this judgment, what that person is making, you get it reviewed to ensure that none of his judgments were biased. Got it? So this will be the safeguard. So that is very obvious, potential employment in the client's location. Okay, then. Next, contingent fees. Now, the meaning of the word contingent is that your fee is dependent upon something. So there is an ACCA firm who has decided as an agreement with the client that we are going to take the fees which are as a percentage of the profit. So they must have decided that 2% of your profit will be our fees or 5% of your profit will be our fees. Now tell me, if profit is the figure which is going to decide your fee and profit is a part of financial statement, don't you think any which way you are going to try to bring the profits look very good? Because the profit will decide your fee. So you will definitely have a financial interest in this financial statements. This profit element is going to decide the amount that you are going to receive. So whenever there is a contingency on the fees, that is contingent fees are there, they're dependent upon any element of the financial statement. Then in that case, make sure you don't have any kind of criteria of a contingent fee. Because obviously then you are never going to be unbiased. You will definitely try to show the profit figures to be very good. Okay, because purely it will be dependent upon the profit. Correct? Then the auditor would have an incentive to ensure a particular outcome is achieved in order to maximize the audit fee. Because I know more the profit, I'll get more the audit fee. So obviously I will try to do something which is going to maximize my audit fee. So even if there are misstatements in the current financial statement that they are presenting, I will not highlight if they are bringing a reduction in the profit amount. Correct? Then, example, overlook audit adjustments that would reduce profit if the fee is calculated on the basis of profit. Got it? So any adjustments are there which is going to affect the profit, and if they are wrong, you will try to ignore it. Correct? Because if profit reduces, your fee will reduce. Correct? Then fees based on a particular outcome, example, level of profits of the company, are not permitted for the audit engagement. So whenever you take up any audit engagement, ensure the way in which the fee is decided, it should be lump sum amount. It should be a straight figure. 5 lakh is our fee, 5 lakh is our fee. That's it. Do not make it dependent upon any other variable expense or the variable criteria. Okay. Contingent fees are not permitted for non-assurance service provided to an audit client if the fee is material to the firm. The outcome of the non-assurance service is dependent on the future judgment related to the audit of the material amount in the financial statement. Now, what they are trying to say is that, see, as of now, the entire ethics that we are studying is with respect to the external audit, which is nothing but the assurance engagement. But now, ACCA firms not only provide assurance, but they also provide other services. Like they could provide tax consultancy services, they could provide bookkeeping service, some financial management service, some recruitment services. There could be multiple avenues where they are working or they're providing service. So there could be a particular client who takes both the service from us. They could be taking audit also from us. They could be taking some other service also from us. These other services are also called as what? They're called as non-audit service or non-assurance service. So here they're telling it is also important that audit, obviously you don't take on contingent fees. But we would recommend that you don't even take the non-assurance services as a percentage. Especially that percentage which is dependent upon an item of the financial statement which has an impact on the audit. Okay. So if it is material amount, so assume it is some 5 lakhs, 10 lakh, depending upon the materiality of the amount. And this non-assurance service is dependent upon some percentage. And the criteria is somewhere connected to the financial statement. Then obviously it will have impact on the audit also. Correct? So they say both. Assurance engagement also don't keep percentage on the LE element. And non-assurance also, you please do not give it anything on percentage if that amount is really material. Got it? Yes. Then, moving further, here there is just an example given to you for the loans that we have already studied. Okay, if you remember yesterday, loans and guarantees, we are not permitted to take unless they are on the normal course in the arm's length price and normal transactions and all. Correct? Now, an audit team member working on the audit of a bank is offered a loan at a preferential rate due to their involvement with the audit. Now, you tell me, without moving further, if you understand carefully, if you look at this line only, it is directly telling that this particular member will now develop a self-interest threat. Because he has not got this particular preferential rate and all this benefit only because he's a regular customer. He has got this only because he's involved in the audit. So don't you think the banker is trying to create some kind of threat, some kind of, grabbing the interest of this person so that they give a favorable opinion? Correct?
Yes.
The loan must be declined. That means the audit team has to decline the loan, or the member of the audit team must not take up the loan as would not be offered under commercial terms and conditions available to everyone. That is, every other customer won't get the preferential rate. Therefore, could affect the judgment of the auditor. Affect the judgment as in his objectivity will get compromised. He will now start thinking in the favor of the bank. Got it?
Yes. Moving
further, we have, you could mute yourself, okay? Yeah. Moving further, we have compensation and evaluation policy. Now, this is something, something different to understand, but not very difficult. Compensation and evaluation policy. Okay, the thing is, sometimes what happens is, suppose there is a particular ACCA firm and This firm is into different avenues of practice. So they are giving consultancy service, they are giving tax services, they are giving some management advisory services, they are providing assurance service of audit also. Okay, they are also providing recruitment service. They are providing multiple services. Now, what they are telling that we will, pay an individual. Okay, also depending upon the level of non-audit services that you can acquire from the particular client. That means I am telling that suppose if Mr. B is going to do the audit of A Limited and Mr. B is the employee of whom this ACCA firm. So this ACCA firm, what they have done is they have put a policy that Mr. B will be paid or compensated if suppose they bring A Limited also to take another services from us. Audit we are going to do. But if you try to persuade, if you try to somehow bring A Limited to also take another service of us, non-assurance service like tax consultancy, okay, management advisory, then we will pay you extra. So here what is happening is, only because now Mr. B will try to impress this particular client, because his entire pay will now be dependent upon him to bring non-audit service also from A Limited. Correct? So this particular firm also wants to give these other services also to A Limited. Correct? So they are telling Mr. B that look, when you do the audit of A Limited, you also try to get them to actually take up another service also from us. Got it? So how much other services contract you get? Based on that, we will give you compensation. Okay. So suppose Mr. B, when he was doing the audit of A Limited, he also somehow managed to make A Limited get convinced with him, and also A Limited, because of the work in which Mr. B has done, or in which B has actually carried on the work or persuaded A Limited. A Limited now is also interested in taking tax service from us. Now, what the management has told B Limited, that is ACCA firm, they have told B Limited that if suppose you are able to get another non-audit client or non-audit service for us to be rendering to A Limited, we will pay you extra for this. Now tell me, don't you think B will try every possible thing to make A Limited, okay, take even tax service from the client, from the firm? Yes. Now here what will happen? B will try to impress A Limited anyhow. Because B knows if I try to persuade this client and also get him another service to be taken from us, he will be paid extra. So don't you think his self-interest will come into this picture? Yes. Okay. So they say a self-interest threat is created when a member of the audit firm is evaluated. That means the amount that you're going to pay to him, or the performance that you're going to give him, or the appraisal of this person will be evaluated, or he will be compensated for selling non-assurance service to that audit client. So while you do the audit, ensure you also sell other services that we are providing to the same client. So till now, they took only audit from us. And if you manage to sell even tax consultancy service to them, then because you got this service, we'll pay you extra. Got it? Okay. Now, significance of the threat will depend upon the proportion of the individual's compensation or the performance evaluation that is based on the sale of service. If suppose very less percentage, they give you only 1% or 2%, then fine, no problem. Okay, because it is immaterial. The role of the individual of the audit team. Okay, whether promotion decisions are influenced by the sale of such service. That means I have told, I will make, suppose I have told Mr. B is now working in the maybe executive capacity in this particular firm. I will promote him to the next level. Okay, only if he gets this particular service, if he sells the service. Got it? So all of this will be depending upon.
1 second, ma'am. Let me plug in my charger.
Yeah. Okay. So here they say these all things also will be very important for us to decide regarding the significance of the threat. Okay. So all these things also will play important role. Further, they are saying, how will you safeguard it? Safeguard will be very simple. Do not try to evaluate anybody's performance based on the sale of service. Because if you're trying to tell him that I'll pay you extra if you sell the service, definitely his interest will be developed. Correct? So try and make such policies where none of the audit member, okay, or the audit team member will be actually getting benefited if he brings some kind of sales services or he's selling the services. Okay. So the firm shall revise the compensation plan or evaluation process of that individual. Do not evaluate him on the basis of what he's selling. Okay. You will evaluate him only with the work that he's doing. Remove that individual from the audit team. Very important. Okay. Then have an appropriate reviewer to review the work of the member of the audit team. This is a common point. Clear? All right. Now, moving on to the next one, key audit partner. Okay. Key audit partner, basically, we have actually some terms used like engagement partner. We have also a term called as key audit partner. Okay. So these are the two different terms that we use every time. So you must have seen, I always use the word engagement partner. Sometimes you also use the word key audit partners. Now, what do you mean by them is, engagement partner is going to be that partner who is going to actually go and engage with the client. Okay, put the proposal of doing the audit. Actually, they are going to finalize whether audit has to be done or not done. So they are the people who are actually going to get the contract of audit or get this service decided. Okay, they are called as the engagement partners. The people who actually talk first to the client, telling that we are going to offer the service to you and all that. But key audit partner is that partner who actually goes and does the audit. Got it? So key audit partners shall not be evaluated or compensated based on their success in selling non-assurance service to their audit client. So basically, the one who's in the field of doing the audit, he will have more of the work to be done. He will be having more judgments to be made. So his judgment should not get influenced because of this kind of interest. Got it? So more than any other partner, we are focusing this policy to not be made for a key audit partner. Okay? All right. Now, actual or threatened litigation. Okay, actual or threatened litigation is maybe there is a firm. Okay, the firm has three partners, ABC. Okay, it's an ACCA firm. They're doing the audit of one of the clients. Okay, and the client is maybe Z Limited. Now, A was actually doing the audit of Z Limited. Okay, but there's something went wrong during the course of audit. Now, Z Limited is threatening that, look, A, you better do it. If you do anything wrong or if you don't change it, we will bring a case against you or we'll file a case against you. So now, obviously, to escape from this, your interest will be involved. Got it? So because there could be something wrong going on where Z Limited has told that if you do like this, we will definitely what we'll do. We will file a case against you, or there has been some kind of mistake which has happened because of which now A is actually scared also. Okay, it is not threatening like just for, replacing you and all that. No. Here the thing is real. Something has gone wrong because of which Z is telling we will file a case against you or the entire firm only. So in that case, because you have an interest, you want to please the client again. Don't you think it'll work in the favor of the client? Yes. Got it? So litigation could represent a breakdown of trust. So because you did something, now Z Limited doesn't have a trust in you. It's a breakdown of trust in the relationship between auditor and the client. This may affect the impartiality of the auditor and lead to the reluctance of the management to disclose relevant information to the auditor. Now, when you know that A has done something wrong, okay, do you think Z Limited is actually going to reveal all the information to A Limited easily now? No, because the trust which was there has now broken down. So now everything what A is going to ask, X will not be that much interested in giving the information. So because of which what happens, it will affect the impartiality of the auditor. The auditor will get biased. Got it? Then the significance of the threat will depend upon the materiality of the litigation and whether litigation relates to prior assurance engagement. Okay? Then it may be possible to continue other assurance engagement depending on the significance of the threat by discussing the matter with the client. So you discuss the matter with the client, try to persuade him and tell him what was the situation and all of that. If the litigation involves an individual, remove that individual from the engagement team. So in my example, it was A who was involved here. So don't let A be the key audit partner. Let B and C take up the audit. Got it? Then again, you have the appropriate reviewer to review the work. Got it? But suppose if you believe no safeguard is possible, you are not even, whenever you're discussing with the client is absolutely not okay with it. You are not able to eliminate anybody and put somebody. Like, for example, it could be possible that it's an IT sector which audit you're doing. And out of the three partners, A, B, C, it is only A who understands IT business properly. And B and C actually have no knowledge about the industry only. So do you think they could be replacing A in this particular audit? Not possible. Got it? Because of the expertise which A has, B and C cannot take the position. So second also could not be possible. So in that case, what we are saying is if things are not possible, then it is better you withdraw from the engagement. Got it? You withdraw, because anyway, if you're not doing it independently, then there's no point in you for you to do the audit. Got it? All right.